A stock adding roughly $60 billion in market value because a CEO said 4 words on stage. That is where Tuesday's session actually lived, behind the headline of 3 indices closing at simultaneous all-time highs. The S&P 500 gained 0.1% to a new record. The Dow rose 0.5%, also a record close. The Nasdaq finished fractionally higher, also at a record. On paper, it was one of the quietest all-time high days of the year. Beneath that quiet, capital was repositioning hard into one corner of the AI trade. Marvell Technology closed up 33%, the largest single-stock percentage move among Nasdaq's significant names on the day. Hewlett-Packard Enterprise rose 19%. The two moves did not emerge from earnings or guidance revisions. They emerged from a conference stage in Taipei, where NVIDIA CEO Jensen Huang appeared alongside Marvell CEO Matt Murphy and told the audience that Marvell is going to be the next trillion-dollar company. Within hours, tens of billions of dollars in market value had moved. Alphabet fell nearly 4% after announcing an $80 billion equity raise to fund AI compute infrastructure. Microsoft declined more than 4%, the largest drop among the 7 largest tech names. Those 2 declines created a quiet but visible rotation signal. Capital was leaving the model layer names that have already been repriced and moving toward the silicon layer beneath them, the chips and connectivity hardware that those models depend on to run at scale. That rotation is what made Marvell's session possible, but the rotation alone does not explain 33%. The surface read on Marvell's move is that Jensen Huang said something nice on stage, and the market ran with it. The element that changes the picture is what accompanied the comment. NVIDIA disclosed a $2 billion equity investment in Marvell, paired with a broad AI partnership agreement. The verbal endorsement and the capital commitment arrived together, and the distinction matters for how to read the position pressure that followed. A $2 billion equity stake means NVIDIA is now a stakeholder in Marvell's revenue trajectory. When Jensen Huang says trillion-dollar company while holding $2 billion of the stock, the comment is no longer analyst commentary. It is a disclosure of where one of the most capital-efficient technology companies on Earth has decided to place a directional bet. The market's 33% response was in part a response to that disclosure being priced as confirmation that NVIDIA's own infrastructure expansion requires Marvell's connectivity silicon to work. Marvell's role is specific. The bottleneck in AI data centers has shifted from raw compute, the number of GPUs running, to the speed at which those GPUs communicate with each other. Marvell builds the high-speed networking and connectivity chips that allow thousands of GPUs in different racks to behave as a single distributed system. Without that layer, more GPUs produce diminishing returns. NVIDIA's $2 billion investment is a direct signal that this bottleneck is real, that Marvell is on its critical path, and that the partnership is not incidental. That is the premise the buyers on Tuesday are treating as given. If NVIDIA's own growth depends on solving the interconnect problem and Marvell is the named solution, then Marvell's addressable market scales with NVIDIA's data center expansion, not as a supplier with fixed margins, but as a co-infrastructure layer with pricing power. Here is where the premise requires scrutiny. Evercore analyst C.J. Muse, consistently ranked among the top semiconductor analysts on Wall Street, called Jensen's trillion-dollar remark a little more aspirational than real. The current gap is not small. Marvell entered Tuesday's session at roughly $190 to $200 billion in market capitalization. A $1 trillion valuation requires 5 times that figure. For Marvell to reach $1 trillion on fundamental earnings, it would need either revenue growth at a rate that currently has no guidance anchor, or a sustained multiple expansion that assumes the networking silicon market becomes as large and as durable as the GPU compute market itself. Muse's skepticism rests on a different premise from the buyers. Valuation at $1 trillion requires earnings justification, not partnership announcements, and the transmission path from NVIDIA's preferred networking partner to 5 times current revenue involves a number of competitive and structural steps that today's price already assumes are resolved. The $2 billion investment is real capital. The endorsement is real attention.
But the distance from here to 1 trillion is a 5 times expansion in a market that does not yet have a clear ceiling, a clear timeline, or a clear earnings model for Marvell's specific contribution to it. Both of those premises, the buyers and muses, can be held simultaneously. The session repriced which premise has more near-term capital behind it. That is not the same as resolving which premise is correct.
The unresolved question from Tuesday's move is whether Marvell's 33% gain marks a genuine re-rating of the networking silicon category, or whether it marks the moment when the AI infrastructure premium got priced one layer too fast. That question has a verification structure. Marvell's previous run-up already took the stock above most analyst price targets before Tuesday's session. After a 33% move on a partnership announcement, the stock now sits substantially above the sell-side consensus. Analysts whose models were built on prior Marvell revenue assumptions, not on an NVIDIA equity partnership, now face a choice. Either upgrade price targets to reflect a new revenue per chip or volume assumption derived from the NVIDIA relationship, or maintain prior targets and acknowledge the stock is pricing in outcomes their models cannot yet justify. The first wave of analyst revisions in the 48 to 72 hours following Tuesday's close is the earliest observable signal of whether the repricing has institutional support or is running ahead of it. The historical comparison that applies most directly is ARM Holdings after its 2023 IPO, when NVIDIA's public endorsement and minority stake drove a repricing that ran significantly above fundamental consensus before earnings delivery provided a reset. ARM's first post-IPO quarter was the moment where the valuation either found a new floor or began compressing back toward the model. For Marvell, the equivalent event is not an IPO. It is the next quarterly earnings report, where custom silicon revenue tied to the NVIDIA partnership would need to show up in segment disclosures for the thesis to find a fundamental anchor. A continuation of Tuesday's repricing has a clear condition. If Marvell's next reported quarter shows measurable revenue growth attributable to AI networking deployments at hyperscaler clients, specifically the kind of accelerated custom ASIC and connectivity silicon revenue that NVIDIA's expanded partnership implies, the $200 billion to $1 trillion gap has a growth curve to run along. The other side of that condition is equally concrete. If quarterly results show that the NVIDIA partnership has not yet translated into accelerated shipment volumes or improved gross margins on the networking product line, the 33% premium exists entirely on the expectation that it will, and the 5 times gap to $1 trillion becomes harder to hold at current prices. The $2 billion NVIDIA equity commitment introduced earlier does not close that question. It changes the confidence interval around when the revenue might materialize, not whether it will. Jensen Huang's 4 words on stage in Taipei moved $60 billion of market capitalization in a single session. Whether Marvell's next earnings call moves the analyst consensus target up to meet the stock, or moves the stock down to meet the analysts, is where Tuesday's bet settles. Every day after the close, we publish a market wrap and key issue analysis. Subscribe to the channel.